Welcome to the Tax Talk Podcast. On today's episode, I am chatting with Rylan Olson. Rylan knows everything there is to know about corporate life insurance, and we are going to be delving into the topic of life insurance and its benefits for corporate ownership. So, if you are contemplating the purchase of life insurance within that corporation, whether it's to fund a business buy-sell agreement or for any other particular option, you will want to check out this episode with Rylan as we dig into the details that are going to help you decide what is best for you and your corporation going forward. Welcome to the Tax Talk Podcast and an exciting episode with Rylan Olson. Rylan is the co-founder of Swell Advisory and a partner at Swell Private Wealth Ltd. He works with ultra high net worth Canadian families to provide tailored insurance solutions that serve as a powerful tool in their financial future. Rylan, I want to thank you for hopping on the podcast with me. Really looking forward to breaking into the corporate cash life insurance policy discussion with you today.
Happy to be here. Thanks, Jared, for having me.
Excellent. So today we are going to delve into corporate cash value life insurance. I know this is a topic that is probably a bit of a mystery to my clients. Rylan specializes in this field, so I wanted to bring him on, give you guys some value for what you might be looking for with a corporate life insurance policy, how that's going to benefit you, your business, your legacy, the next generation, all those things. So without further ado, let's jump right into it. So Rylan, when deciding to purchase that corporate-owned life insurance policy with that cash component, what are some things that a business owner might want to consider beforehand before purchasing that policy?
Jared should be on board. There should be no at the end of the year saying, hey, look what I did. I did this thing and I bought this life insurance policy and here's what's going to cost. Because life insurance planning, especially corporately owned life insurance planning, is a coordinated approach. There needs to be all professionals tug-of-warring against the world, I guess you could say, in the same direction, not pulling in different directions. So before purchasing a corporately owned life insurance policy, you need to consult with your accountant and get your accountant into those meetings with that advisor to say, here's the problem that we're trying to solve. Here's what we're trying to accomplish. Here's what we're thinking. What are your take or what are your thought or how does this impact the planning that we're currently doing? And so nothing should be done without your accountant on board or at least informed of what's going on. So that would be point number one.
Perfect.
Anything you want to add there?
I couldn't agree more. I find if you have some good, thought process between all the parties that are going to be involved in this particular policy purchase, it's just going to make sense both short-term and long-term to ensure that you're getting the proper plan put into place, the proper policy, and ensuring that you're not looking, what is the hot thing on the market today? We're looking at something that is going to be of benefit to you and the business and your legacy down the road. So I would definitely agree with Rylan on that aspect. Getting everybody on your team and in your corner before making a decision is going to make the most sense.
Yeah. And your accountant most of the time has seen a scenario or it's very similar to your own scenario. And so they can see into the future or your future a little bit. I bet an accountant's never been called a seer before, but it can see into the future. And they can predict maybe roadblocks or concerns that we're going to have. One of those concerns, talking about corporately owned insurance is, and I don't want to get too technical, but it's something called purification of your company. And so we don't want to put an insurance policy into your company if you have, maybe the idea of selling your company in the future. And so that's just one small example. We don't have to get into the specifics of purification, but there's a lot of traps and there's a lot of future planning that we don't want to put the insurance in place knowing that maybe we're going to sell the company in the future. We got to transfer it out. We got to do a fair market value. We're going to trigger if we don't want to we're trying to make sure that the plan makes sense now and 20 years in the future. And that everyone, as I said, is pulling the rope in the same direction. And so we want to just make sure that the plan is consistent. And once again, Your accountant needs to be on board and needs to understand what's going on, because if they don't, you're going to run into problems. We've just seen it way too many times where clients do something without their accountant understanding, and it screws up the planning that the accountant's doing.
For sure. And I mean, then that exactly makes sense. If you put in that policy into that corporation, you might be thinking it's a great idea. I'm protecting myself, I'm protecting my family by getting this policy into place. But maybe you and the accountant had a discussion just recently that you were looking to sell, and this is going to completely throw this all offside. Like Rylan mentioned, there's ways to deal with that after the fact, but you're just adding this added complexity and then more than likely accounting and legal fees that are going to be tacked on top of this. So why not have the discussion ahead of time, put that policy maybe into a holding company if that's where it needs to go, and then you're
Yeah.
setting yourself up to protect yourself short term should anything happen, but also long term, you're looking at these are the goals that we have in mind and the steps that we need to take to get there. So makes sense
Yeah.
for sure.
Yeah. Yeah. There's three simple questions that we ask. And you can ask yourself this question if you're thinking about buying corporately owned insurance. First question is, what is the purpose of the insurance? It's a simple question, but a lot of times people buy insurance and we ask them, why did you do this? And they're like, well, I the advisor said it was a good investment strategy. And we're like, well, you don't have a reason to buy insurance. As much as insurance advisors want to hit the nail with the hammer, insurance is not a fix everything problem, like a solution. It doesn't fix everything. It fits very specific, very good planning, but it doesn't fix every planning opportunity. And so, what is the purpose of the insurance? Very simple. You should be able to answer in one sentence. The purpose of the insurance is because I want to donate it to a charity when I die and leave a legacy to that charity. Awesome. I want to transfer wealth to my kids in a tax efficient vehicle. Awesome, right? Just be able to define what's the purpose. So that's question number one. Question number two is, who is going to pay for it? Where is the money coming from? And so sometimes people think, well, yeah, I'm going to buy it from my company. My company's got money. I don't want to take out money personally to pay for them to put it in my company. That's fine. But we need to know, where is the money coming from? Is the company going to deplete its cash flow
Mhm.
by buying a permanent policy? Is that going to, if you have growth that you've talked with your accountant before of, we want to expand, we want to buy more warehouses, we want to buy a bigger fleet, whatever it might be, is that depletion of your cash flow going to hurt your operations? Well, that, where's the money coming from? Third question is, when does the proceeds show up?
Right.
Right. And so you might have a company and you say, well, yeah, does it happen when the first owner dies? Is it a joint life where maybe two lives are insured? So what's the purpose? Who's paying for it? When does the proceeds show up? And where do the proceeds show up? Do they show up in the company? They show up in a holding company? And so those are the three questions that we want people to feel crystal clear on: what is going on, why they're doing it, and where the money's coming from and where it's going to go.
Yeah, very good points. And I think that's a good place to start. Answering those three questions is going to help you get to the point where you can probably make a fairly effective decision that's going to benefit you in the long run. If you're bringing on maybe a key employee or two, maybe you need to be setting up a buy sell agreement, and maybe there's a particular use for a life insurance policy within the company at that particular juncture. But
Yeah.
again, that is your reason for getting this. It's not just because Joe Blow, the investor guy, told me it would be a good idea, or whomever you talk to on the streets.
Yeah.
Everything I see from not just the accounting standpoint, the tax side, the legal side, there has to be some sort of operational benefit to it.
Mm.
Just because you can put in some sort of plan that makes sense tax wise doesn't mean it's a good idea operationally. Maybe you need
Yeah.
that cash flow to go buy a new shop or a new truck or whatever the case is. Maybe now's not the time. Maybe you just need some sort of bridge policy, a term policy to get you through the next couple of years. Maybe it makes sense to get that permanent policy in place after that. So having
Yeah.
these discussions with Rylan is going to get you to the place where you're making the best decision, getting the best bang for your buck.
Yeah. Yeah. And I just add, have those conversations with Rylan and Jared
Right, right,
and the
right.
accountant, right? And I think that's a great point. You should be asking yourself, can I solve this problem using term insurance?
Right.
It doesn't always have to be a permanent life insurance policy. We convert a lot of policies. And what I mean by converting means we buy term insurance, which is cheap,
Mhm.
early, and then we convert a portion or all of that term insurance into permanent insurance later, right? And so, can you actually fix the problem? Maybe it's key person, like Jared said.
Mhm.
Can we actually solve this problem using term insurance? Maybe it's buy, sell between partners. Can we actually solve this using term insurance, which is way cheaper for your business and not have to use permanent insurance to solve the problem? So that's another great point, because that's another key consideration. Is there another way we can solve this that fits our needs better?
Right. Right. Just because it's the most shiny object out there doesn't necessarily mean it's the right one for you. Maybe there's a simpler, cheaper solution that is going to do you much better. Why not just go with that? You don't need
Yeah.
the glossy policy that's going to cost you in excess of whatever it is that you're willing to dole out on a regular basis. Have those discussions, find the policy that works for you.
Yeah. And I just want to be clear. I'm not saying that permanent insurance is a bad solution,
Mhm.
because it can fit in situations, and lots of situations it can fit. But is there a way that we can maximize the planning and timing, and like, can we not just get the policy, but can we take it to the nth degree to make the plan as as good as possible? And maybe that means buying term for 3 years and then converting it so we can save for 3 years so we can buy that shop or whatever it might be, right? So
Perfect. And I think that kind of leads into this next section. So, what are 6 benefits of owning a life insurance policy with that cash aspect to it within your corporation? Obviously, there are benefits. I see them with my clients all the time. I tell basically everyone that walks through the doors, you know, what the right solution is going to depend upon you and what you have going on. But let's explore some of those benefits for that individual that's maybe looking to put that policy in place in their corporation.
yeah. So first one, which is easy peasy, is when buying a life insurance policy in the corporation, you're using after corporate tax dollars. And so any high income earner realizes that, hey, if I want to go buy that new vehicle personally, I'm taking out a lot of money personally because I got to pay high personal taxes so that I can go buy my personal vehicle, right? Same thing with insurance. If we can buy it using after corporate tax dollars, well, we're getting more bang for our buck because we're not having to pay that personal tax rate. And so buying it with corporate dollars is cheaper because we're not losing money to the tax man.
Right. And I think in certain circumstances, it's going to make sense for you to do that. I think you have to take into consideration where the company is and where it's going. Like
Yeah.
Rylan touched on at the top, if there is a potential to sell that business in the near or somewhat distant future, it might still make sense to put this in place for the general planning of maybe you and your family, but then maybe you're wanting to use after tax dollars in the corporation as opposed to putting that policy into that operating company. And then you get yourself
Yeah.
that issue with the just the overall asset mix that's within that operating company. So good point there for sure. I would completely agree. If you can use those after tax corporate dollars to fund these things, it probably makes sense in a lot of respects. But getting
Yeah.
that policy put in the proper place is going to maybe save you some big dollars down the road in the planning side of things for sure.
Yeah. Yeah. Another key point, and as Jared mentioned, we deal with a lot of larger size family owned businesses. And so they outgrow the small business deduction. And so Jared can touch on this a little bit more as he's the tax specialist and the accountant. But a life insurance policy with cash value that doesn't actually contribute to the AAII grind,
Mhm.
which grinds down your small business tax rate. And so it's actually a passive investment inside your company that doesn't grind down your small business rate, which is huge, right? And so if you can have if you can preserve your small business rate as long as you can, then that's awesome.
Yeah, and further to Ryland's point, it gives you the ability to maybe put some of that excess cash into some sort of investment vehicle. Like he mentioned, that's not going to strip away your access to that low rate. In Alberta here, we're looking at 11%. You want to do everything in your power to maintain your access to that low tax rate. It just gives you the
Yeah.
flexibility to continue to grow that business with those cheap after tax dollars. So, if there is the need for the policy, that is a potential option to look at. And it could maybe potentially keep some of that planning simplified for you. There is no ability to sell that company down the road. It's just a service business. You're tied into it. There's no hope of ever selling that. You've got some funds that you want to leave in there to grow for, retirement and legacy planning. That might be a vehicle that you then choose to pursue as opposed to moving all those excess corporate funds into some sort of non-registered account. It'd give you
Yep.
some advantageous tax deferrals on the growth there as well. So definitely something to kind of keep in mind for sure.
Yep. Now, maybe I'll just add a point to that.
Sure.
So as Jared touched on, there's the cash component, which can grow over time, and it can grow to be pretty significant. In an insurance policy, that's actually tax sheltered growth.
Hmm.
And so the money that's inside that policy actually does not occur taxation during the growth period. And banks love this stuff because insurance policies, cash value, there's guaranteed and there's non guaranteed cash value. You can go to a bank and actually use these policies as collateral to get a policy or to get a loan against it. And the banks like them so much that they'll give upwards of 90 to 100% of the cash value
Hmm.
because they're so secure. The bank knows that it's there, they're assigned collateral, and they know that if something happens, they're getting their money, right? They don't want your home, but they want you, they'll take your life insurance policy, right? They have very favorable lending on life insurance policies. But not only can you use it as collateral, you can actually go to the insurance company and actually get a loan directly from the insurance company.
Hmm.
And so instead of using a third party bank, you can actually go to whatever carrier it might be. And there's lots of carriers across Canada. You can actually go to them and say, hey, I want to access some of my policy cash value. And you can take that out if you want and say, that's my money. I want to use it for operations, whatever it is. There might be some tax consequences. Or you can say, I want a loan. I want a policy loan. And I want to take an actual, I don't touch my cash value. I take their money and I use it and then I pay them back just like I'd pay back a bank, right? Now, there's considerations of do you want to use a policy loan versus a bank loan, which you can get into. Sometimes policy loans are a little bit higher interest rate, but they're instant. Like you
Right.
can go to the carrier and in 3 days have your money, right? And so a
Crazy.
lot of people are using that as like a bridge financing in their business. Saying, look, we've got to do X, Y, and Z. We need the money quick. We know that we're going to have a liquidation event. We'll go get a policy loan. We'll use that as a bridge. A month later, they get the liquidation or the liquidity event. Sorry, they get the liquidity event
Mhm.
and they pay back the policy loan, right? And the policy's still continuing to go. So it can be a really good tool to use inside your business. It's a good asset and it is an asset to have on your balance sheet, right? And you can use that in a lot of different ways.
100%. And I know a lot of my clients that maybe get into this particular position, I think they get to the point where the life insurance maybe becomes an option, but I think this sometimes becomes a bit of a hiccup for them in the overall scheme of the plan. You know, I'm going to put some money into this, but then what happens if I do have some growth interests? I want to pick up on this deal that comes along that's too good to be turned aside. And I'm sticking all these premiums away into this policy. Yeah, I want to plan ahead for my kids, but at the end of the day, I need to make this business work because ultimately this is my legacy. And if I can't make this function, I'm not going to be able to really turn anything over to them anyways. And with all due respect, yeah, I want to give them some cash upon passing
Mhm.
potentially, but I want to get to the point where I could retire and enjoy myself too. So I think this is something that maybe is not necessarily known well out there that, yeah, you can put this in place. and you can borrow against it, and you can use it to, move that business ahead. I know one client off the top of my head, they've got policies, his and hers, and they've got it in place and they board against the cash value of it, and they're using it to continue to purchase equipment and move this business forward. The end goal would be to repay that at some point in time, but you might as well use some of that liquidity to keep furthering that business when the right deal comes along, instead of just maybe having some of those funds trapped away and waiting there until you pass away sometime.
Yeah. Yeah, and there's a whole can of worms we can open with this on just how to actually structure the policy.
Hmm.
And what we're explaining to me is options and features, but it's not the actual strategy. And I always go back to those three questions because a lot of times people will be approached by an advisor saying, "Hey, look, put the money in, leverage the money out. We can do that." And now they're pitching a strategy, and they're selling a strategy where I view
Hmm.
it as, no, these are features and options for a policy that has a specific purpose, going back to number one.
Right.
Right? What's the purpose? Oh, it's for my family. Oh, but I have these 7 other features and options that I can exercise that give me flexibility, but I'm not deviating from the purpose, right? Because a lot of times these policies get pitched to people as these tax-free savings account, corporate structure, whizzle dizzle, put the money in, take the money out, and it gets really complicated really fast. And I love that we can build policies that are flexible
Mhm.
and can they can serve multiple needs at the same time, but we have to remember what the purpose is and why we bought it in the first place, because that's when people can't answer it. They can't answer what's the purpose. They're like, well, the guy said I put the money in, then I leverage the money out, and then I put that into flow through shares, and then I move it. And it's like, you're making a lot of complexity and not really getting ahead any, because like you're doing all of these things. It's like a car stuck in the mud and they're just pinning it and it's going 100 miles an hour, and they're like thinking they're going somewhere and they're just stuck in the mud, right?
I
So,
could not agree more. I don't know how many times I sit down with clients and I say, just keep it simple. There is no point coming up with these elaborate plans that move money from here to there to open up a new corporation, to have this thing come out. Now we need a personal trust in here. Just keep it simple. Like
yeah,
Rylan said, what is the purpose of what you're trying to do? Let's figure that out, and then let's find the most economical, affordable, simple solution to put into place. Because generally speaking, what I find, if something's understood by the client, it's much more likely to be acted upon, and it's much more likely to have success long term. If you roll out a reorg binder with 500 pages and all this complexity to it to get from A to wherever we're going, the client's not going to understand what it is that we're trying to do. They get lost, they get frustrated, the fees are existential as a result of it, and more often than not, we've probably missed what the purpose was in the first place. So let's just keep things simple.
yeah. No, and good point. And something I'd add there is, which I don't think many people think about, is who you buy your life insurance from matters. And I can use a lot of reasons why, but I think you have to realize that life insurance is not like purchasing home and auto insurance. A lot of people are think insurance is the same. And so they're just used to just going in saying, "Okay, give me full coverage, give me whatever it is. I buy it. It doesn't matter who I buy it from, and I walk away and I don't have to worry about it." A lot of people buy their insurance and think, "I bought it, I'm done, I don't have to worry about this." That's not true.
Mhm.
Your life insurance policy, and especially if there's cash value and there's these features and there's these options, and I'm not saying it has to be complex, but who you buy your insurance from is going to be partnered with you for the rest of your life, and then hand your beneficiaries a check on their most miserable day.
Right.
And a lot of people don't realize that who I'm buying it from, the integrity of that person, the character of the person. Do I actually get along with the person?
Right.
Because I'm going to deal with them, and my kids or my company is going to deal with them when they hand that check. Or does the company have a succession plan? In our company, we're tiered. My partner's older than me. I'm younger than him.
Mhm.
The next person that comes on is going to be younger than me because the clients and the policies that we're selling, we're going to have to deliver to those beneficiaries. If we, as an insurance provider, don't have a continuity plan, then how are we going to be able to say with certainty to you, we are going to take care of your family, your business with this check on the worst day of their life, and we're going to be there, and we're going to tell them what your plan was, why you wanted it, how you felt about it, where it was going. We're going to be able to explain it crystal clear. And I don't think many people think about that. They just buy it from whoever's going to offer it, right? And whoever's closest, whoever's, you know, and so it's just a consideration is who you buy your policy from matters.
Right. So if you're talking permanent life insurance, it means just that, permanent. So if you're going to go to the planning of setting this policy into place, you might as well do a bit of background to ensure that the company and the individuals that are going to be delivering this to you over the course of this could go on for quite some time, depending upon when you actually first initially get that policy out. You want to make sure that you're working with a firm and some individuals that you respect now, you think your kids can work with, and that
Yep.
I think that'll just generally bring the whole plan into a full roundabout when it actually comes time to see that policy check paid out. So,
Yeah. Yeah. So that's a good point. Another point that I want to talk about with corporately owned insurance, like Jared said, it's permanent. So it's going to be there when you die. It's not going to expire. But permanent insurance and life insurance in general creates this accounting term called capital dividend account,
mhm.
CDA. And what that account does is allows you to flow money out of a company to personal hands tax free. And life insurance creates capital dividend account. And so the death benefit, for the most part, the total death benefit, for the most part, is the capital dividend account. And so if you've got $1 million death benefit in your company, you die, that $1 million shows up, that $1 million flows out of your company to your estate tax free, right? And so sometimes there's what is the purpose of the insurance policy? Sometimes that purpose is we want capital dividend account because we have assets in our company that we would love to flow to our estate to be in their personal hands and be out of the company. And so that's another huge benefit that a lot of the ultra high net worth individuals are buying insurance just for that reason because nothing creates CDA better
Mhm.
than life insurance. And now we're in this right now whirlwind, and Jared can attest to this of the capital gains inclusion rate
Mhm.
because that affects CDA as well. And it's going up, it's down, it's flopping around. What I can tell you is life insurance creates CDA, and CDA is immensely valuable for pulling money out of your corporation into your estate's hands tax free.
I would agree, and I think it's especially important if you do, like Ryland said, have some assets within that corporation. Maybe you've got some things that you're holding personally, and you've got some sort of legacy plan in place that you want to see some of these things go to, maybe certain beneficiaries. That life insurance policy creates that CDA, which creates the liquidity that enables your estate to manage your assets in a manner that you so choose. If you
Yeah.
are potentially shy in the liquidation area, things may potentially need to be liquidated that you otherwise would not like to. And then as a result, your wishes, as they're put out in that will, may not come about in the way that you want. So I think this is a key piece for, like Ryland said, some of these individuals that are maybe on the higher net worth side of things to long play and really look at what that legacy is going to be like, put this piece into place,
and then ensure that what they are, leaving to the next generation is exactly the way that they intend it to be.
Yeah. Yeah. Now, another point that I just want to, and this is an analogy we use a lot of time, is there's a lot of different ways that you can structure your life insurance policy. There's a lot of different companies that you can buy life insurance from in Canada. And the analogy we use is it's like buying a truck. You can buy a Ford, you can buy a GM, you can buy a Dodge, you could buy a Nissan, you could buy a Rivian, I guess. Maybe.
Maybe a
And each
Datsun, a
one,
Datsun.
yeah, you could buy a Kenworth.
Yeah, all sorts of
Anyways,
options.
Peterbilt.
Yep.
So not pickup truck. Sorry. Let me get back to the analogy. You could buy it's about like buying a pickup truck. And
Mhm,
so each pickup truck's different. You have an F-150 and an F-350. You
mhm.
got a dually, you got an extended cab. And so they're all trucks, but they're all built a little different. Maybe you like it a little more luxurious inside. Maybe you want towing capacity. Maybe you need more ground clearance. Whatever it might be, not all trucks are the same, even though they're the same category.
Right.
Not all life insurance is the same. Not all trucks are the same. And so the advisor that you work with should understand the differences and the mechanisms to say, ooh, this is the purpose. This is why you want it. This is what you're doing. Ooh, maybe you have some health considerations. If we go with this company, if we go with Ford, they don't look at that health
Mhm.
consideration the same way that GM looks at it. So we can get a more favorable outcome using this company, right? And so who you buy your insurance from an insurance company perspective can determine the outcome, the total outcome at the end of what you're trying to accomplish, right? So just because you put $1 in doesn't mean every company is going to get you $5 out, right? Some might get you 5.2, some might get you 4.8.
Right.
And so if it matters to you to get the absolute best, well, then you should be looking across all carriers to see who with my situation can give me the best outcome.
Right. So looking for that advisor that you previously mentioned that is going to help you both
Yeah.
currently and long term, not Mr. Individual that is just looking to sell the most shiny life insurance policy that's out there on the market right now, but actually the one that fits your why the best. That's what you
Yeah.
should be looking for.
Yeah. Yeah. And here's a small tip. If you're in this process, you're going through this process with it's not with me, and that's okay. Is if you're doing it, that's good planning. And I'm not trying to self promote here. I'm saying doing this type of planning is better than not doing any planning at all. When talking about cash value life insurance, ask your advisor or whoever you're talking to, what's the required premium and what's the optional premium? That's another one of
Mhm.
the features that we talked about, right? And so say you're putting $100,000 in a year. Well, you might only be required to put in 50,000
Mhm.
and 50 is optional, right? And so as your business ebbs and flows or you have different opportunities, we have this happen all the time. We have a farmer, a client that I can think off the top of my head
Mhm.
that's putting in money. And this year they had the opportunity to go purchase more land. And so they said, hey, we're not going to put in the optional amount this year.
Right.
That's great. We're only going to put in the required because we built in the flexibility for them.
Mhm.
While times were good, they're like, we can do this, we can do this. Oh, opportunity. We're not going to put in the optional so we can use that money. And then next year, they might put the optional in. They might not. Maybe they'll put only a percentage in, right? But required premium versus optional premium. And if someone's not building in premium flexibility, they should be able to explain why.
Mhm.
Like, why do I not have optional versus required? And there's use cases. We've done a few policies where it's all required premium because the people are extremely liquid, right?
Right.
And they want the best estate value in 30 years from now.
Mhm.
And by putting it all required, we're able to get a bigger number at the end, right? So, but
Gotcha.
that's a good, if you're an operating business, you're working, you're currently don't have as much liquidity as you want, but this is still a planning tool that you want to use. Ask about required versus optional premium and if you can mix that.
No, and that makes sense. As a business owner, anybody listening to this podcast, you're well aware that business ebbs and flows. And
Yeah.
being able to kind of roll with the punches and having that flexibility in there to take on things that come up that you might not necessarily otherwise expect is maybe what makes or breaks you at certain points in your business career. So again, probably beating this like a drum, but finding that advisor that you can trust that lays out your options, explains how those particular requirements or optional amounts are going to impact you going forward. They should be able to sit down with you and the accountant and say, what does that business cycle look like? Are you anticipating, some seasonal changes? Does that impact things? Does there a requirement to get out of your shop lease and go buy something in a couple of years? Well, if that's the case, you don't want to be locked into some policy that is going to see all of your cash flow go into there in the next number of years. Have these conversations, find the advisors that are willing to do it, because I know they're out there. I know there's people willing to look outside of the compliance box to have this discussion. Rely upon them and their previous experience to, get that in your corner and push your business forward for sure.
Yeah. Yeah. And COVID's a great example, right? Where nobody knew it was going to go on. And so we're instantly talking to our clients saying, look, we can drop this optional
Mhm.
amount off, right? You don't know what the future looks like. And so they were able to be flexible. We were able to use some of the levers to say, ooh, your business is shut down. Well, we're going to pull some levers and compress this down so it's not as big of a cash flow deterrent, right? And so
Right.
you don't know what's going to happen as a business owner. You don't know, and so you need the flexibility. You need the ability to move and change things on the fly, and that comes to policy design.
And that makes sense because when a client comes in and they're asking me about whatever it is, whether it's life insurance or putting together a buy sell agreement or whatever the decision of the day is, you need to go into it with the expectation that the worst possible situation could happen. You don't necessarily ever want to see it, but you should be planning for that. And if you plan for that, if it does happen to happen, you're far more prepared and you're in a much better place to take on those challenges. No one could have
Yeah.
anticipated markets shutting down and businesses being shuttered. But if you had planned for potentially a worst case, you probably had some options. Whereas the individual that maybe went into the purchase of that life insurance policy just looking at the shiny new policy that was available to them, maybe didn't have that flexibility that was built in there.
Yeah, and that's why partnering with the right advisor on who you purchase the policy from, because these conversations should be had annually. You should
Mhm.
be talking with your insurance advisor saying, well, how's it performing? What are we on pace? Are we doing what we thought we were going to do? Because a lot of advisors like to show illustrations, say, look, in 20 years, it's going to be this big. And those are projections. That's like me saying, well, what's your current stock portfolio look like? And then let me just do what it's this year, what it did. And I'll just look 20 years and be like, whoa, look, you're going to like this. It's like, well, that's not the case. And
Yeah.
so just because illustrations on insurance policies say one thing, that doesn't mean they perform the same way. And so you need to be having annual conversations with your insurance advisor. Your insurance advisor will update your account saying, here's the updated cash value of the policy. Here's
Mhm.
the updated adjusted cost basis of the policy. Here's what we're doing. And the accountant knows what's going on. Everyone's pulling in the same direction. Everyone's working together, not, hey, he just sold me something and then I never heard from him again.
Right. Because it is business transition planning or estate planning, whatever you want to call it. But the plan is never a one time thing. You don't get everyone into the room. You make decisions on everything that's going to happen for the next 25 years, and then you never look at it again. It is
Yeah.
a ongoing living plan that you need to stay on top of to ensure that it is always coming back to that purpose. Are you still fulfilling that purpose? And
Yeah.
believe it or not, your purpose today might not be what your purpose is in 5, 10 years from now. So if you don't talk to your advisor for 15 years and then all of a sudden it's time to collect on this or to do something within your business that this is going to impact, well, you might not be in the place that you anticipated to be because you set that policy in place 15 years ago and then you tuck those papers into the filing cabinet and you forgot about it. So that plan needs to be an ongoing thing. That policy and the discussions with that advisor need to evolve on a regular basis to ensure that you're always up to date and fulfilling that purpose.
Yeah. Yeah. Awesome.
Perfect. Any closing remarks on the importance of a cash value life insurance policy in a corporation that we haven't hit on? I think you've laid out some great information for anyone listening to keep top of mind when they're putting a policy into place, when they're consulting with an advisor. Anything else you want to touch on real quick?
Yeah. I think Jared actually said this, and we say this all the time: simplicity brings clarity.
Mm-hmm.
And so the simpler we can make things, the better. And remember that in your insurance plan. Your insurance plan can be as complex or as simple as you want it to be. And it can be simple and still have the features, optionality, and ability to move the levers to make whatever we need to happen. And so having conversations with your insurance advisor and your accountant allows your insurance advisor to pull those levers on your behalf. A lot of times we don't know what's going on because you're busy operating the business. And the more you can communicate with your professional team, the more we can help you achieve the goals that you've set out for. So that would be my closing: is make sure you partner with the right person who you know has your best interest.
Mm-hmm.
You vetted them, you like doing business with them, you like talking to them, because these people need to be part of your professional team. And so if they're not, then you need to get another advisor who can look at, maybe have a policy in place and you're listening to this.
Mm-hmm.
You're like, oh, I haven't talked to that guy in 15 years or 10 years. What do I do? Do I reach out to him? A new advisor can become the agent on that policy.
Mm-hmm.
And so if you do have someone that you like, they can do an agent of record change where they can become the agent. They can see everything. They can communicate with the insurance company on your behalf, and they can start now working together with you and your accountant to see what the best course of action is for your insurance policy. So that would be my final thoughts on the insurance. One other thing I want to add to the audience is about Jared. We deal with accountants across Canada, and Jared is one of the very few accountants that is proactively trying to find planning opportunities for his clients and share knowledge and information with his clients to make sure they get the optimal outcome. So I just want to commend Jared for his dedication to his clients. You have a diamond in the rough, and this, sincerely, there is not very many accountants like Jared in all of Canada who are willing to have a podcast, to willing to talk about topics they're uncomfortable with, and to bring up planning opportunities for you. A lot of times accountants are looking in the rear view mirror of the truck.
Mm-hmm.
They're saying, what happened? Let's put it down. What happened? Let's put it down. They're not looking out the front windshield saying, what's coming up? What can we avoid? How can we make sure we get to the destination carefully, successfully? And Jared's doing that. And so I just wanted to commend him publicly to you, to know that you've got a really good accountant on your hands.
I very much appreciate that, Rylan. It has been a great pleasure to me to delve into these conversations, to be able to learn more, to bring those into that client meetings. I find a lot of value myself in being able to help my clients to kind of think outside of the box, look in that front windshield as opposed to looking at that rear view like you had mentioned. So thank you for that. I appreciate that. And I look forward to continuing to learn from you as we move along. So I just wanted to say thanks again, Rylan, for hopping on the podcast with me. If clients do want to touch base with you to put a new policy into place, to review what they have ongoing, what is the best way that they can get a hold of you?
Yeah, Swell Wealth is swellwealth.com is our website. Swell, SWELL, wealth. And so you can reach us there. If you're on LinkedIn, we're on LinkedIn all the time. You'll see me, you'll see Jared posting. Connect with me on LinkedIn and you can reach out that way. But yeah, website's the best way, swellwealth.com.
Excellent. Thanks again, Rylan. For the Text Talk podcast, I am Jared Pallon. Thanks again for listening. Stay tuned for the next episode. We appreciate you guys listening. Take care, and we'll talk again soon.